Section 5, Ratio Analysis. By this stage, we've learnt about how the basic accounts fit together, your balance sheet, your income statement, the cash flow statement. What we're going to do now is start to understand what some of the numbers are telling us and how we can interpret them. Now, ratios are giving us the link between, a basic ratio is one number divided by another number, and it's giving us a relative size. How big is one number relative to another number? If I say we have receivables of 10 million euros, on its own, it doesn't tell you very much. You need to compare it to something else. And that's what we're going to be looking at. We'll divide them into a few different groups here. We're going to look at liquidity, working capital cycle, and profitability, and then we'll finish with earnings per share. And we'll see that you can interpret the numbers in a range of ways, but the level of information you get from the accounts is enough to get a good understanding of what the business is up to. Let's begin with just defining what a ratio is. It's one number divided by another number. So if I say current assets is so many pounds or dollars or euros, it's less useful than saying it's a certain proportion of another number on the balance sheet. So if I say now, here is a ratio that we've calculated, it's giving us a certain amount of information about how a company's performed. You can get even more information by saying, well, how does that compare to this company last year? Has it got better or worse? And you need to work out whether bigger or smaller means better or worse, depends on the ratio. Is it better or worse than a competitor? Is it better or worse than the rest of the industry? Or is it better or worse than if the company had made a different accounting decision? Remember early on, we talked about the choices managers have, and we're going to talk, there's a whole section coming up on this. If the managers choose to change one of their assumptions, for example, from long asset lives to short asset lives or the other way around, how's that going to affect certain ratios? And we can have a look at that. Once we've understood the calculations, we can do analysis like that. So it's an important skill that we need to be able to use, that we need to be able to apply to the financial numbers. Now, we're going to put on some hypothetical numbers. Don't worry, it's an artificial example, but try and understand how we're doing the analysis rather than the actual mechanics of this company, Hawtrey Inc. So this is in dollars, we're working in thousands of dollars here. You can see that we've got cash, receivables and inventories, PP&E, investments and intangible assets on the asset side, then overdraft payables, a bit of tax liability as current liabilities payable within a year, long-term debt and some finance leases under long-term liabilities. A finance lease is, as we defined it very briefly earlier, you're using an asset and agreeing to pay over many years for it, and it's a long-term commitment, so it's long-term liability. And then that's made up by equity. You've got some preferred and common stock and some retained earnings. And it all balances 3,300 assets, 3,300 liabilities and equity. Do please check that you agree with that. Here's the income statement. Revenues just shy of $6.5 million. You've got COGS, operating expenses, bit of interest, bit of tax, down to net income of $560,000. Now, let's begin with some liquidity ratios. These are what we call pure balance sheet. So we're going to look at two numbers straight from the balance sheet, and we begin with the current ratio. You have current assets and current liabilities, and you read them straight off the balance sheet. All the calculations, by the way, are done here. If you need to check that, do please refer back to the balance sheet and income statement that I've just shown you, and confirm that the numbers are correct and confirm that the calculation is correct. For the purposes of this, I'm not playing with the calculator. I'm simply going to analyze what we use these numbers for. So the current ratio, current assets over current liabilities. Your current assets, remember how we defined current assets? They're items that will turn into cash within one operating cycle. So if it's receivables, we need to collect them. If it's inventories, we need to sell them and collect them. And then your current liabilities, which need to be paid within 1 year. So when we look at the current ratio, you want current assets to be generally quite big and current liabilities to be generally quite small. And therefore, the bigger this ratio is, the stronger this aspect of the company looks. So here we have 1.86. It means that our current assets are nearly twice as big as our current liabilities. And although that may seem quite strong, it's not actually that big compared to a lot of other companies. So 1.86 is close to 2, that's sort of a bit of a bare minimum. but it does depend on the company. For example, we've just done the example Boscombe. Imagine a retail business where all sales are for cash, but all purchases are on credit. Now, we had that in the Boscombe example, but imagine any supermarket chain. If you go into the supermarket and do your weekly shopping, you're paying in cash, or you pay on card and they get the cash from the bank within a few days. If you are selling, let's say you sell tins of cat food to the supermarket, they're not going to pay you for a good month or two. And so they're going to have a lot of liabilities. And the result of that is, for retail businesses, the current ratio may end up being actually a very small fraction. It may be well under 1. And it doesn't mean it's unhealthy. You need to compare it to other companies, compare it to how it was last year, and therefore be able to get behind what the numbers are telling you. So that's the current ratio. In general terms, main headline is bigger is better. Now, the quick ratio, this is also known as the acid test. Now, what this is doing, it's equivalent to the current ratio, but we are removing inventories from the assets, from the current assets. So you've basically got cash and accounts receivable. Now, why are we removing inventories? What this is doing is saying, how much cash do we have available? Now, of course, cash is there sitting in the bank already. Accounts receivable. Now, what could we do to those to turn them into cash? Think what accounts receivable represent. They represent our customers who have bought goods from us and who have promised to pay us. So what we can do, we could offer them an incentive to pay. Now, that incentive can be possibly a discount that would normally be agreed up front. It could be we could send them some letters if it's overdue, or you can go to a financing company and borrow using those receivables as collateral. So in other words, if you're owed, in this case, what are we owed? $710,000. It's possible, because they have promised to pay, you can use that as collateral for a loan, and companies will lend to you in order to get over some cash flow issues that you may have. In other words, the receivables represent money that you will get at some point, and given a little bit of tweaking, you may be able to bring that date forward. Now, the reason they're called quick assets is because you can generate cash from receivables fairly fast if necessary. Why has inventory been removed? Well, answer, it's not a quick asset. Think about inventory. How do you turn inventory into cash? Answer, I'm sure you're saying to yourself, you sell it, but that's only half the answer. You sell it and then collect the receivable. Because when you sell it, that turns into a receivable, unless it's retail, and then the receivable turns into cash when you collect it. But the point is, turning inventory into a receivable means you've got to sell it. No one has agreed to buy it yet, and you can't do it in a hurry. So receivables are your customers who have promised to pay you, they just haven't paid you yet. Inventories, no one's promised to pay anything. No one's bought them yet. So inventories are a slow asset. You cannot turn them into cash in a hurry unless you sell them at a very low price. And therefore the quick ratio is a bit closer to liquidity, because you're excluding that slow asset. What do we mean by liquidity? So the overall top definition. Liquidity generally means anything to do with cash. So if internal liquidity is the company's operations able to generate cash. So here, your current assets we've seen will turn into cash at some point. Your current liabilities need to be paid from cash at some point, and therefore these are liquidity ratios. So there's your current ratio and quick ratio, and there's our starting point.